Okay, my name is Bobby Vaught. This is the third video in a long series about everything that you need to know about investing, okay? If you go through this whole series, lesson 1, lesson 2, lesson 3, and on, this is lesson 3, you're going to be an A-plus knowledge investor. You're going to know more, no more than 99.999% of the people out there. The first video, if it had to do with don't be a gold bug. I do not recommend buying precious metals, gold, silver, palladium, platinum. You have bigger fish to fry. If you're already not into that, into buying those things, you can skip the first video. If you are, I strongly recommend you go back and listen to lesson 1. Otherwise, start with lesson 2. Okay, if you're new to this channel. Okay, so lesson 3, we got a lot to cover in this. This is about the stock market. We're getting into some detail now about exactly what to look for in the stock market. So we got a lot to cover here today. Revenue growth, earnings per share growth or EPS, dividend growth, payout ratio. Don't confuse that with the PE. That's a valuation. That's another lesson later down the road. Understanding, very important to understand the difference between current yield and yield to cost. I'm a big believer in dividend growers. Okay, so let's get into it. Some of the things that you want to look for when you're analyzing, when you're crunching numbers. Okay, you want strong revenue growth, preferably double digits or higher, double digits. Earnings per share growth or EPS. Dividend growth, double-digit dividend growth. A low payout ratio. A payout ratio is the current dividends divided by the dividend per share divided by the earnings per share. It's dividends divided by earnings. Okay, so you're looking for a low number there. You want a dividend grower. You want dividend growers, but you want a low payout ratio. That means they have a lot of room to grow the dividend. The combination of revenue growth with earnings per share growth and a low payout ratio means they have that company has a lot of room to grow the dividend. All right, understanding the difference between current yield and yield to cost. This is so important. The current yield is the dividend per share divided by the current price of any stock. It's the dividend per share divided by the current price. That's the dividends per year. Okay, typically they pay per quarter. The dividends per year divided by the current price. That's the current yield. A yield to cost is a little bit different. A yield to cost is the dividends divided by what you paid for it. It's a ratio or a fraction. Dividends divided by what you pay for it. Very important to understand in yield to cost, whatever you paid for it, if you bought something at $100 a share, it could go to $80, it could go to $200, it could go to whatever, okay? But the yield to cost, that cost part of that fraction, that ratio, the denominator, think of the dividend as the numerator, the cost as the denominator in a fraction. That cost doesn't change. It's a constant. Whatever you paid for it, that's what it is. You paid $100 a share, the cost is always, that cost for that purchase is always going to be $100 per share, regardless of where the price goes. All right? So this is very important to understand and understand that difference between the current yield and the yield to cost. Each purchase is going to have a different cost. You may buy shares at $100 and maybe later buy the same security at $110 and later buy some more shares of the same security at $120. Each purchase has a different cost, but for each individual purchase, the cost is whatever you paid for it. That doesn't change over time. All right. So we're going to look at a couple of examples here and just think about this for a moment, okay? There's a man I used to know. I had coffee with him sometimes. He moved, elderly gentleman. He was probably about 90 years old at the time he moved. I live in Corpus Christi, Texas. He moved to Tennessee. But I would have coffee with him sometimes, and he was always talking about, every time we talked about the stock market or mentioned a particular security, he would want to know, well, does that have a good yield? And by that he meant he was a high yield guy. He wanted things like 3%, 4% yield. You should be very skeptical when you see yields that high. It's not that there are a couple of things in my portfolio that pay over 3%, but out of maybe 31 stocks I have, a couple of them pay a little over 3%. I have a whole lot of things that pay 1% or less. Okay? Don't just blindly look at high yield. The reason people do that, like that guy that I know that he moved, the reason people oftentimes just blindly look at high yield, look at the current yield, is because they're trying to reduce investing down to something that they can understand. Okay, I'm going to invite you to expand your horizons a little bit here and consider an example. MasterCard. We're going to compare something like MasterCard to Verizon. All right, MasterCard. It has a payout ratio right now about 21%. Remember, payout ratio, don't confuse it with the PA, with the PE, price to earnings. We're going to cover that when we talk about valuations in another lesson later. Payout ratio. Remember, the payout ratio is the dividends per share divided by earnings per share, or dividends divided by earnings. Okay? Payout ratio for MasterCard right now, ticker symbol MA, is 21%. Now let's compare that to Verizon. Verizon, right at about 100% payout ratio. When you see payout ratios that high, when it starts, approaching like 60, 70, 80, 90, 100%, and definitely if it's over 100%, that's a big warning sign. Okay, if you see a payout ratio over 100%, that means they're paying out more in dividends than their earnings. Well, obviously they're not going to be able to maintain that unless you have significant revenue growth to kind of catch up. Otherwise, it's inevitable. They end up cutting the dividend. You don't want companies that cut the dividend. That's disastrous. That is the most disastrous thing imaginable. You want companies that are increasing the dividend. Okay, so MasterCard, ticker symbol MA, payout ratio. I'm making this video on July 31st, 2024. Okay, so if you want to verify the numbers, depending on when you see this video, these numbers could be a little bit different. As of today, the payout ratio for MasterCard is 21%. Low payout ratio, good. Anything less than 50%, generally that's what you're looking for. Verizon, payout ratio currently about 100%. Okay, the dividend growth rate, the revenue growth rate for MasterCard, going back several years now, 4 or 5 years, 10.42% dividend revenue growth rate. Okay, for Verizon, revenue growth of 0.4%, a little less than 0.5% annualized over the past 4 years. And that's been the trend for Verizon for many, many, many years. The current yield, this is where it gets really important. Current yield for Verizon, 6.64%. Sounds like a great yield, right? Beware of yield traps, high yield traps. We'll talk more about that maybe in this video, maybe in another one. The current yield for MasterCard is 0.59%. There's many things in my portfolio that pay 1% or less dividend, including that one, MasterCard. Okay? But the dividend growth rate for MasterCard, we'll look this up here. It'll take me a minute to bring this up on my spreadsheet. Dividend growth rate for MasterCard. I'm going to talk while that's coming up. Okay, so It's very important to look at the dividend growth rate, not just what the current yield is. I'm going to click a button here because I should have had this before I started making the video. That's fine. Yeah, I should have had this up on my computer. Okay, so you're looking for the dividend growth rate, the combination of a low payout ratio, revenue growth, earnings per share growth, EPS growth, and means the company has a lot of room to grow the dividend. Okay, all right, I got it on my spreadsheet here. Dividend growth rate for MasterCard, this is going back to the last 5 years, 14.87%. Good. Wayne Gretzky, this is so important for investors to understand. Wayne Gretzky, and I'm not a real big hockey fan, but I mean Wayne Gretzky said, "Don't skate to where the puck is, skate to where it's going." You translate that to investing. Don't just blindly look at high yields, at the current yield. Look at the revenue growth, the earnings per share growth, excuse me, and the dividend growth. A low payout ratio means they have a lot of room to grow the dividend, and will continue to do so as long as they have revenue growth and earnings per share growth. There isn't any reason why they wouldn't. Okay? So, understand the very important, there's no way for me to emphasize enough, understand the difference between current yield and the yield to cost. And I'll give you an example. 2013, I bought United Health. So the yield at the time in 2013, the current yield when I bought it was right at 1%. It's like 1.0005%. Okay, keep in mind, now the current yield, now it's 2024, July 31st, 2024. The current yield for United Health now, 1.46%. Okay, but the yield to cost, they keep increasing what the dividend is. United Health has been increasing their dividend at about a 13% clip over the past several years since I bought it. The yield to cost today, keep in mind, this is the current yield divided by what I paid for it, the cost, which is a constant. Just like when you buy your car, whatever happens to the car doesn't change the cost. Whatever you paid for it, that's what you paid for it, right? Whatever you paid for this, that's what you paid for it. The cost is a constant. The yield to cost on that purchase, when I bought United Health in 2013, the current yield is 1.46%. The yield to cost on that purchase is now 7.5%, 7.5%. At the current rate of growth in the dividend, in 21 years, it would have a 100% yield to cost, that purchase that I made in 2013. So what do you do with it? Well, it's still going higher. What do you do with it? Well, you leave it to your kids. If you're not going to live that long, you just keep passing it down, right? I'm 63 years old. I figured to live another 21 years at least, of pretty good health. But in any event, someday I'll pass on, and I'll leave it to Elena, my wife-to-be, and my fiance, very soon going to be my wife. And then when she's 20 years younger than I am, so it's probable that she will outlive me, although not definite. But in any event, so when then she passes on, and she leaves it to her kids, and just keeps growing. 100% yield to cost. In other words, getting paid every single year what you paid for the stock. Let me say that again. Getting paid every single year what you paid for the stock. Verizon growing the dividend roughly about 2% a year. It's going to take them very, very long time. In fact, we could calculate that. 6.64 You bought Horizon today, it's paying a current yield of 6.64%. It would take you 137, if growing the dividend about 2% a year, it would take 137 years for Verizon before you're getting paid every year what you paid for the stock. United Health, 21, and I bought it 11 years ago, roughly 35 years. That's so important to understand. Don't skate to where the puck is, skate to where it's going. All right? Don't just blindly look at high yields. Next thing I wanted to cover, really important, compounding and something else. You want to get to a point in your investing life where you're living on dividends, but you're also reinvesting at least some dividends. Currently, I've got to a point where I can reinvest half of the dividends and live on the other half. All right, 50% of all dividends. I always just keep buying more shares. You always want to have more later. When you use dividends to buy more dividends, and notice that doesn't have to be in the same stock, by the way. It can be. If you use dividends to buy more dividends in some other stock, it's still compounding. Why wouldn't it be? Okay, so you're using dividends to buy more dividends, buy more shares, more dividends. That's compounding. Everybody understands compounding. In the case of MasterCard, United Health, every single thing in my portfolio is a dividend grower. Claycourt Tenor, D.H. Horton, Domino's Pizza, Pool, they do pool supplies, Primerica, on and on and on. Every single thing in my portfolio is a dividend grower. They keep increasing what the dividend is. It's the only asset class that can do that. Not yellow and gray shiny rocks, not preferred stocks, not bonds. There is a time when you want to look closer at bonds, when to buy them, when not to buy them. That's going to be another lesson. Okay, I don't want to get too off on a tangent here. The only asset class where they keep increasing what the dividend is, because not yellow and gray shiny rocks, not preferred stocks, not bonds, only common stocks do that. Why are they able to do that? Because when you buy common stock, you are an owner of equity. All right, you are an owner of capital, okay, or owner of means of production. That's what capital is, means of production. So the world gets bigger. They produce more. They sell more product. They increase the dividend. It's what dividend growers do. They increase the dividend because they produce something and they increase revenues. They increase revenues, they increase earnings per share. You are an owner, they increase the dividend. All right, it's the only asset class that can do that. So, use dividends to buy more shares. They keep increasing what the dividend is, dividend growers. The combination of those two things, think of it as compounding squared. Think of it as compounding squared. Over a period of years, it can be turned into something just massive. This is how people acquire wealth, produce wealth in the stock market. This is the number one way they do that, by buying more dividends and having dividend growers. All right, so that pretty much covers everything. Future videos, we want to talk about something not to do, anecdotal investing. That's probably going to be the next video next Sunday. We still have to talk about bonds. We didn't get into valuations, the PE and the PEG yet. Profit margin is something very important to look at. Okay, so all of that's going to come in the future lessons. For right now, understand, and your brokerage has these numbers. You can also find it on Yahoo Finance, some of it. Although you should probably trust the numbers from your broker or another website that I like a lot called stockanalysis.com to show you all these numbers. For right now, you just remember revenue growth, earnings per share growth, dividend growth, low payout ratio. Those are the things you want to be looking for. Other than the first thing, which we covered in lesson number 2, it's something you can't really quantify, high entry barrier. Okay, so we still got to talk about profit margin, valuations, and at some point we're going to talk about bonds, when to buy them, because they're, despite everything I just said, and bonds is not an asset class that can do what it just said. The bonds don't increase the coupon. It's the same coupon for the life of the bond. But nevertheless, there can be a time when you want to buy bonds, and we're going to cover that in a future lesson. All right. It has to do with interest rates and fluctuate or changes in interest rates. Okay, so that just about covers everything. Really important, understand the difference between current yield, yield to cost. Don't just blindly look at high yield, what's paying the most current yield. If investing were that simple, everybody would just be buying things like Verizon or a couple of the pharmaceutical companies, or so forth. Okay, so I hope that helped. That was lesson 3, and I probably ran a little bit long here. So hope you have. This is Wednesday. I hope you have a great week, rest of the week, and happy investing. See you next time for lesson 4.